The current situation in Ukraine has a lot of investors asking themselves, how might a major war between Russia and Ukraine impact the overall stock market? So I wanted to dive into this question with you all and find out how global conflict might impact the stock market by looking back on historical data. The one thing I'm sure we can all agree on is that the stock market does not like uncertainty. The goal of most investors at any given day is to buy stocks at fair prices based on their projections of future growth, such as revenue and profits. Since no rational person wants to overpay for stocks, if the future starts to look cloudy for the overall market, the stock market's going to reflect that. And if one thing is for sure, a massive war is going to bring on a bunch of uncertainty for the countries that are involved. So how do stocks generally perform during wartime? Well, it actually depends on a few things, such as who is involved in the war, where is the war being fought, how long might the war last, what type of economic damage will the war bring, and how might the war impact the economies of each country that is involved. A large war is going to require more resources in the form of labor and capital, which will likely take a toll on the economy depending on how long the conflict lasts, and how well each country's economy can handle the additional financial burden due to the war. For the sake of this video, we're just going to focus on the historic performance of the stock market in the United States based in past wars. To start out, if a large war were to break out, companies that produce resources for the war, such as Boeing or Lockheed Martin, would likely perform well during these times due to the increase in spending by the government to purchase new equipment needed for the war. If we look back at history, there has historically been both bull and bear markets during wartime. So the short answer to the question of how might the stock market react to war is it basically depends. If you look at this chart over here, you'll notice that almost all initial global conflicts start with an initial drop or sell-off in the market due to the surprise that the market is starting to digest. So basically every historic crisis that has ever began started with an initial sell-off due to the uncertainty that that event brought. Anytime a global event brings any sort of uncertainty, the markets are going to likely get spooked. That might not come as no surprise, just because we all know that the market craves certainty. So any sort of event that's going to cause mass uncertainty is likely going to be reflected in the stock market. It gets difficult for investors to project into the future when the future starts to get uncertain due to global conflicts. So as you might guess, the bigger the conflict, the more market volatility will likely take place. Over the long run, however, the US stock market has historically done well during war times. As surprising as it might sound, stocks have generally done better than average during war times if we look back at historic wars in the United States. Of course, that has not always been the case, such as during the Gulf War or the Vietnam War, as highlighted in this chart over here. How popular a war is at home can definitely influence the sentiment in the stock market. So for example, if we look back at the Vietnam War, the low supports at home for the Vietnam War could have likely influenced the overall stock market as well. If we look back during World War II, which was one of the most devastating wars the world has ever seen, stocks generally rose during that entire period. But there was a lot of volatility during certain events that occurred during that war. This could be due to a bunch of different reasons. The most likely reason to me is that during war times, the government's going to spend a lot more money in order to pay for the resources and equipments that it needs for war. Inflation and war tend to come hand in hand. So as the government starts to spend more money into the economy, a lot of that money is going to end up in the revenue and the earnings of the companies that are receiving that money. Now let's take a look at Germany's stock market during World War II. You can see here that just like the United States, certain events caused a lot of uncertainty and volatility in their stock market as well. But towards the end of the war, when it was clear that Germany was no longer winning, the German stock market nearly went to zero. So one might be able to make the conclusion that the winning economy that gains more power post-war will end up with a stronger stock market as well. While on the flip side, the losing country, their economy will likely lose confidence and see a weaker stock market. So in conclusion, investors have historically shrugged off wars after the initial conflict has kind of been digested. Stocks have surprisingly generally done well during war times, especially the stocks that directly benefit from some sort of war. War and inflation kind of run hand in hand, since financing wars are expensive and the governments that have to raise money for wars will do so in the form of debt. So most investors probably prefer to hold on to some sort of asset rather than the country's currency during times of war because of the increase in inflation, causing the stock market to rise during these times of uncertainty. The length of war plays a huge factor as well. If we look back during the Afghanistan war that lasted over 20 years, during that 20-year period, markets saw both historic highs and market crashes. So it seems that the longer a war goes on, the more likely the war just becomes a part of the economy and investors begin to price it in as such. All that being said, past performance never, of course, guarantees any future performance or returns. The future is almost never like the past, but it certainly does rhyme at times. And it seems, based on looking back at history, as long as the home economy of the country you're investing in stays intact during war times and is not severely damaged like it was in Germany post-World War II, investors can likely just assume that the war is just a temporary financial burden on the overall economy and might even benefit from the increased government spending if their local economy can actually handle it. Well, thank you so much for watching and have a great rest of your day.